Hi, I'm Mark Farber and this is Accounting Fundamentals. In our last video, we talked about the difference between cash accounting and accrual accounting. And prior to that, we've looked at a whole bunch of different transactions that a company does, generally on a day-to-day basis. So selling revenue gets recorded at the moment that it's sold, and purchasing things gets recorded as you purchase them. But there's a bunch of entries that have to be done at the end of each accounting period, whether the period is a month, a quarter, or a year, that are called adjusting entries. And those are related to accruals. In other words, what we're trying to do is balance off the payment of cash against when things actually occurred, when we actually earned revenue or when we actually incurred expenses. And we're going to, in the next bunch of videos, go through a bunch of different types of adjusting entries. The first one we're going to look at is something called prepaid expenses. A prepaid expense is nothing more than an expense that a company incurs where they pay for it in advance. We have an example over here. ABC Company purchased a one-year insurance policy on January 1st, and they paid $2,400 cash for that policy. So on January 1st, if we were to record this using cash accounting, and remember, cash accounting, we incur expenses and earn revenue only when cash changes hands and to the extent the cash changes hands. If we were to use cash accounting to record this, then on January 1st, we would debit insurance expense. I'll just abbreviate it as hum-src-int for $2,400, the amount of insurance or the cost of the policy, and we would credit cash for $2,400. And then on the income statement, in January, there would be $2,400 of insurance expense listed, and for the remaining months of the year, February, March, April, there'd be no insurance expense. So you'd have a huge spike in the first month of the year of expense, and then no insurance expense thereafter. But in fact, that's not really what happens. What happens is the company paid $2,400 on January 1st, but they are going to be getting the benefit of this insurance policy over the next 12 months. And so we can very quickly do the math. The cost was $2,400 divided by 12 months, because the policy is for 1 year, means that, in effect, the company is paying $200 per month for insurance. So there should be $200 of expense in every single month. And so to do that, what we do under accrual accounting, and we'll just put a few of them over here, is on January 1st, we have to record that we purchased the policy and that we paid cash, because obviously $2,400 of cash was paid to the insurance company. Rather than debiting an expense, what we do is we debit prepaid insurance. Let's just do this. And it's going to be for $2,400. Sorry, I'm running out of room here. And we credit cash. $2,400. Okay? So essentially what we've done is we've created this new account called prepaid insurance, and it has $2,400 in it. Then, and that was on January 1st. I'll just move it over here a bit. On January 31st, at the end of the first month, the company has gotten the benefit of 1 month of insurance, or $200 worth of insurance. So on January 31st, they make an adjusting entry. At the end of the month, they will debit insurance expense for $200, the amount that's incurred each month, and they will credit, rather than crediting cash because they've already paid the cash, they're going to credit this prepaid insurance account. So prepaid insurance is credited $200. Again, debits equal credits always. So now if you think about it, think of a big bucket, and we filled it up. This is our prepaid insurance. We filled it up with $2,400 of prepaid insurance. And there's a little spigot over here. And we've now let out $200. So we've let out $200. We now have $2,200 left of prepaid insurance. And the $200 that we've let out has been expensed. So on the income statement in January, rather than having $2,400 of expense for the month, we only have the $200 of expense, the actual cost of the insurance for the month of January. In February, we'll do the exact same thing. So I can change this date to February 28th. It will be the exact same entry, another $200 of expense. At the end of March 31st, we'll do the exact same entry. Okay, another $200 of expense. And so each month, we'll keep letting out $200, $200, $200 until by the end of the year, we've incurred the entire $2,400 of expense. So all the prepaid expense, which is an asset that sits on the balance sheet, will have become an expense on the income statement. But we'll spread it out over the year as opposed to recording it all in one shot. And that's what prepaid expenses are all about. In our next video, we'll take a look at the reverse to this, or essentially the reverse to this, which is unearned revenue.